if you take the average PhD in finance and ask him to value a business, he's got a problem. And if he can't value it, I don't know how he can invest in it. So therefore, it's much easier to take up efficient market theory and say it doesn't make any difference because everybody knows everything about it anyway. And there's no sense in trying to think about valuing businesses. The market's efficient, it's valued them all perfectly. I've never known what you talk about on the second day in that course. I mean, the first, you walk in, you say, everything's valued perfectly, and class dismissed. So it puzzles me, but I encourage you to look for the inefficiently priced.
A huge majority of the business school teaching on the field of investment of passive portfolios of securities is not what we believe and not what Warren was taught years ago by Ben Graham. They're just little pockets of our attitude left. Mostly if you go to business school, you will learn a lot of things we don't believe.
I mean, what you really want a course on investing to be is how to value a business. That's what the game is about. I mean, if you don't know how to value a business, you don't know how to value a stock. And if you look at what is being taught, I think you see very little of how to value a business, and the rest of it is playing around maybe with numbers or Greek symbols or something of the sort. But it doesn't do you any good. I mean, in the end, you have to decide, whether you're going to value a business at $400 million or $600 million or $800 million, and then you compare that with the price, and that's what investing is. And I don't know any other kind of investing, basically to do. And that just isn't taught. And the reason it isn't taught is because there aren't teachers around, who know how to teach it. I mean, they don't know themselves. And since they don't know themselves, they teach something that says nobody knows anything, which is the efficient market theory. And if I didn't know how to do it, and if I ever teach physics, I'm going to come up with a theory that nobody knows anything, because it's the only way I can get through the day, But it's fascinating to me how the really great universities operate in this respect. If you get a sacred writ, you get in the finance department because you sign on, to whatever the present group thinks. And if they think the world is flat, you better think the world is flat too, and your students better answer that the world's flat when they get on exams. I would say finance teaching in this country in general is kind of pathetic.
I've taught at Northwestern, Chicago, Harvard, and Columbia.
Glenn Hubbard is the Dean of Columbia Business School and was the chairman of the Council of Economic Advisors under George W. Bush.
Do you think the financial services industry has too much political power in the United States?
I don't think so, no. You certainly wouldn't get that impression by the drubbing that they regularly get in Washington.
Many prominent academics quietly make fortunes while helping the financial industry shape public debate and government policy. The Analysis Group, Charles River Associates, Compass Lexicon, and the Law and Economics Consulting Group manage a multi-billion-dollar industry that provides academic experts for hire. Two bankers who used these services were Ralph Ciaffi and Matthew Tannen. Bear Stearns hedge fund managers prosecuted for securities fraud. After hiring the Analysis Group, both were acquitted. Glenn Hubbard was paid $100,000 to testify in their defense.
Do you think that the economics discipline has a conflict of interest problem?
I'm not sure I know what you mean.
Do you think that a significant fraction of the economics discipline, number of economists, have financial conflicts of interest that in some way might call into question or color?
Oh, I see what you're saying. I doubt it. Most academic economists, aren't wealthy business people.
Hubbard makes $250,000 a year as a board member of MetLife and was formerly on the board of Capmark, a major commercial mortgage lender during the bubble, which went bankrupt in 2009. He has also advised Nomura Securities, KKR Financial Corporation, and many other financial firms. Laura Tyson, who declined to be interviewed for this film, is a professor at the University of California, Berkeley. She was the chair of the Council of Economic Advisors and then director of the National Economic Council in the Clinton administration. Shortly after leaving government, she joined the board of Morgan Stanley, which pays her $350,000 a year. Ruth Simmons, the president of Brown University, makes over $300,000 a year on the board of Goldman Sachs. Larry Summers, who as Treasury Secretary played a critical role in the deregulation of derivatives, became president of Harvard in 2001. While at Harvard, he made millions consulting to hedge funds and millions more in speaking fees, much of it from investment banks. According to his federal disclosure report, Summers' net worth is between $16.5 million and $39.5 million. Frederick Mishkin, who returned to Columbia Business School after leaving the Federal Reserve, reported on his federal disclosure report that his net worth was between $6 million and $17 million.
In 2006, you co-authored a study of Iceland's financial system.
Right.
Iceland is also an advanced country with excellent institutions, low corruption, rule of law. The economy has already adjusted to financial liberalization, while prudential regulation and supervision is generally quite strong.
Yeah, and that was the mistake. That turns out that the prudential regulation and supervision was not strong in Iceland. And
So
particularly
what
during
led
this
you to
period.
think that it was?
I think that you're going with the information you had, and generally the view was that Iceland had very good institutions. It was a very advanced country.
Who told you that? What kind of research did you do?
You talk to people. You have faith in the central bank, which actually did fall down on the job. That clearly, this.
Why do you have faith in a central bank?
Well, that faith because you go with the information you have.
How much were you paid to write it?
I was paid. I think the number was. It's public information.
On your CV, the title of this report has been changed from Financial Stability in Iceland to Financial Instability in Iceland.
Oh, well, I don't know. Whatever it is the thing. If it's a typo, there's a typo.
I think what should be publicly available is whenever anybody does research on a topic that they disclose if they have any financial conflict with that research.
But if I recall, there is no policy to that effect.
I can't imagine anybody not doing that. In terms of putting it in a paper, it would be significant professional sanction for failure to do that.
I didn't see any place in the study where you indicated that you had been paid by the Icelandic Chamber of Commerce to produce it.
No, I don't know.
Okay.
Richard Portis, the most famous economist in Britain and a professor at London Business School, was also commissioned by the Icelandic Chamber of Commerce in 2007 to write a report which praised the Icelandic financial sector.
The banks themselves are highly liquid. They've actually made money on the fall of the Icelandic krona. These are strong banks. Their market funding is assured for the coming year. These are well-run banks. Richard, thank you so much.
Like Mishkin, Portis's report didn't disclose his payment from the Icelandic Chamber of Commerce.
Does Harvard require disclosures of financial conflict of interest in publications?
Not to my knowledge.
Do you require people to report the compensation they've received from outside activities?
No.
Don't you think that's a problem?
I don't see why.
Martin Feldstein being on the board of AIG, Laura Tyson going on the board of Morgan Stanley, Larry Summers making $10 million a year consulting to financial services firms. Irrelevant.
Basically irrelevant.
You've written a very large number of articles about a very wide array of subjects. You never saw fit to investigate the risks of unregulated credit default swaps?
I never did.
Same question with regard to executive compensation, the regulation of corporate governance, the effect of political contributions.
I don't know that I would have anything to add to those discussions.
I'm looking at your resume now. It looks to me as if the majority of your outside activities are consulting and directorship arrangements with the financial services industry. Would you not agree with that characterization?
No, to my knowledge, I don't think my consulting clients are even on my CV, so
Who are your consulting clients?
I don't believe I have to discuss that with you.
Okay.
In fact, you have a few more minutes and the interview's over.
Do you consult for any financial services firms?
The answer is I do,
And
but I do not want to go into details about that.
do they include other financial services firms?
Possible.
You don't remember?
This isn't a deposition, sir. I was polite enough to give you time. Foolishly, I now see. You have 3 more minutes. Give it your best shot.
In 2004, at the height of the bubble, Glenn Hubbard co-authored a widely read paper with William C. Dudley, the chief economist of Goldman Sachs. In the paper, Hubbard praised credit derivatives and the securitization chain, stating that they had improved allocation of capital and were enhancing financial stability. He cited reduced volatility in the economy and stated that recessions had become less frequent and milder. Credit derivatives were protecting banks against losses and helping to distribute risk.
A medical researcher writes an article saying, to treat this disease, you should prescribe this drug. Turns out doctor makes 80% of personal income from manufacture of this drug. Does not bother.
I think it's certainly important to disclose well, I think that's also a little different from cases that we're talking about here because
I think it is a big problem that education has just kept raising the price. And they say, but college-educated people do better. It's a big bargain. But maybe they do better because they were better to start with before they ever went to college.
Yeah.
And they never tell you that.
It's a ridiculous argument.
And so
I think that's one of the silliest statistics that they publish. I mean, to say that a college education is worth X because people that go to college earn this much more than the ones that don't. You're talking about 2 different universes, and to attribute the entire difference to the one variable that they went to college as opposed to the difference between the people who want to go to college and have the ability to get into college.
It's completely nutty, and about 70% of the people believe in it. So it gives you a certain hesitation about relying on your fellow man. So I think most people just have to struggle through with the system the way it is. There's a big tendency to have prices rise to what can be collected. And people just rationalize that the service is worth it. And I think a lot of that has happened in education. And of course, a lot is taught in higher education that isn't very useful to the people who are learning it. And of course, all those people would never learn much from anything. So it's really wasting your time. And that's just the way it works. What I noticed that was very interesting is that when the Great Recession came, every successful university in America was horribly overstaffed, and they all behaved just like 3G. They all, with a shortage of money, laid off a lot of people. The net result is they all worked better when it was all over with the people gone. And so this right-sizing is not all bad. I don't think there's a college in America that wants to go back to its old habits. But you put your finger on it, it is a real problem to look at those sticker shocks. It's like any other problem in life. You have just to figure out your best option and just live with it. We can't change Villanova or Fordham. They're going to do what they're going to do. And as long as it works, they'll keep raising the prices.
And it'll keep working.
Yes.
Yeah.
And that's pretty much the way the system works. You could argue that the very worst of the academic inanity is in the liberal arts departments of the great universities. And there, if you ask the question, what one frame of mind is likely to do an individual the most damage to his happiness, to his contribution to others, what one frame of mind will be the worst? And the answer would be some sort of paranoid self-pity. Couldn't imagine a more destructive frame of mind. Now you have whole departments that want everyone to feel a victim. and you pay money to send your children to places where this is what they teach them. It's amazing how these pockets of irrationality creep into these eminent places. One of the reasons I like the Berkshire meetings is I find fewer of those silly people.
I think the high priests of efficient market theory are probably not in the same demand for speaking engagements and seminars and all of that as they were a decade or two ago. But it really meant that people who'd spent years and years and years getting PhDs found their whole world crashing around them. I would say that it's been discredited in a fairly significant way over the last decade or two. I mean, you don't hear people talking the same way about it as you did 15 or 20 years ago. But the market generally is fairly efficient in most ways. I mean, it's hard to find securities that are inefficiently priced. There are times when it's relatively easy, but right now, for example, it's difficult. I don't know exactly how much it's holy writ still in business schools. I certainly get the impression as I go around talking to business schools that it is far less regarded, sort of unquestioned dogma that like it was 15 or 20 years ago. It's hard to dislodge a belief that becomes the dogma of a finance department. It's so challenging to them, and they have to, at age 30 or 40, to go back and say what I've learned up to this point and what I've been teaching students and all of that is silly. That doesn't come easy to people. Charlie?
Well, Max Planck, the great physicist, said that even in physics, the old guard really didn't accept the new ideas. The new ideas prevail in due course because the old guard fades away clinging to the asset entities of the past. And that's what's happened to the hard form efficient market theorists. They're an embarrassment to the scene, and they will soon be gone. On the people who think the market is reasonably efficient or roughly efficient, of course, are absolutely correct, and that will stay with us for the long haul.
Thinking it's roughly efficient, though, does nothing for you in academia. You can't build anything around it. I mean, what people want are what they call elegant theories, and it doesn't work. What investment is about is valuing businesses. I mean, that is all there is to investment. You sit around and you try to figure out what a business is worth, and if it's selling below that figure, you buy it. You can't find a course virtually in the country on how to value businesses. You can find all kinds of courses on how to compute beta or whatever it may be, because that's something the instructor knows how to do, but he doesn't know how to value a business. So the important subject doesn't get taught, and it's tough to teach. I think Ben Graham did a good job of teaching it at Columbia, and I was very fortunate to run into him many decades ago.
You learn to think intelligently about how to invest successfully in businesses. You'll become a much better business manager than you will if you aren't good at understanding what's required for successful investment. So they're missing a huge opportunity to improve the management profession by doing such a lousy job in teaching investment.
Yeah, see, Charlie and I see CEOs all the time who in a sense don't know how to think about the value of businesses they're acquiring, and then so they go out and hire investment bankers, and guess what? The investment banker tells them what to do. Tells them to do it because they get 20x if they do it and X if they don't do it, and guess how the advice comes out. So it's when a manager of a business feels helpless, which he won't say out loud, but inwardly feels helpless in the question of asset allocation, you've got a real problem. And they have not gone to business schools that have given them any real help, I think, in terms of learning how to think about valuation in businesses. And that's one of the reasons that we write and talk about it some, because there's a gap there.